welcome to the channel JIV and CIB Made Simple. Today we are going to discuss IIBF Ccp memory based question which were asked on 13th September examination. So basically this question will help you see the kinds of question you can expect in the next examination. Obviously question will not repeat but concept will repeat. So whatever concept you will learn from this question will surely help you in the upcoming examination. So let's get started with our first question, right? So basically the question is, this is a numerical question. You must have pen paper calculator with you, right? And question is, the bank is sanctioning a housing loan of 60 lakh. So how much they are sanctioning? You can see they are sanctioning housing loan of 60 lakh. Margin requirement they have given 20%, right? This is the margin applicable, right? And you know RBI has prescribed L2 LTV cap. What is LTV? Loan to value caps. You know it. So considering both margin requirement and RBI LTV stipulation, which of the following is correct? So option number A says that, you know, bank can lend 48 lakh since margin of 20% applies on 60 lakh. Now let's check this. So friends, what is given here? Let me explain. So margin 20%, right? They have written clearly that margin is 20%. What does it mean? It means the borrower must contribute 20% from their own pocket, right? Borrower must contribute 20% from their own pocket. That is the meaning of saying margin is 20%. So the bank can finance the remaining, right? So bank will finance remaining 80%, right? Now you think about it. Total is 60 lakh, right? Total total loan, housing loan is 60 lakh, right? So what is the 80% of 60 lakh? That will be financed by the bank. That would be 48 lakh. So this 48 lakh is, you know, the bank finance. This look, now let's look at the option. So the bank can lend 48 lakh since margin of 20% apply on 60 lakh. So this look correct from the margin side. But wait, we also have to check the RBI LTV. We also have to check the loan to value ratio. So option A is half correct, only margin side, but RBI rule has not been mentioned. That's why it is incorrect. What about option B? It says that bank can lend 54 lakh as RBI allow maximum 90% LTV up to 30 lakh and margin take care of the rest. This sound tempting, but let's check carefully. What RBI says, you know, RBI says that 90% LTV, right? RBI stipulate that, you know, 90% LTV, it apply, right, only for loan up to 30 lakh. So loan if up to 30 lakh, only then, you know, 90% LTV will apply. But here, what is our loan amount? Our loan amount is 60 lakh. Clearly you can see. Let me show you. You have seen, right? Our loan amount is 60 lakh. So RBI says that if the loan amount is minimum less than 30 lakh, then 90% LTV will apply. But in this case, our loan amount is 60 lakh. So this fall in the slab of, you know, there is a slab. It fall in the slab of 30 to 75 lakh. This slab it will fall. And for this slab, you know what is the LTV? Remember, let me write it down. So if it fall in 30 to 75 lakh slab, in that case, you know, in that case our LTV is how much? It is 80%, maximum 80%. This is the maximum that RBI can permit. So now 54 lakh. So here what is written? 54 lakh. How much is the 54 lakh? It is the 90% of 60 lakh. So this is wrong. This is not allowed. That's why option number B is also wrong. Now option number C, have a look. Option number C is that bank can lend 48 lakh, but the sanction must also comply with RBI maximum 80% LTV norm applicable for this slab. Let's check this. So margin say 20% borrower contribution, right? What margin is saying? Margin is saying that 20% borrower contribution. That is what margin means, right? Margin means borrower contribution, which is 20%. If you find 20% of how much? 20% of, you know, 60 lakh, that would give 48 lakh. So this 48 lakh is the bank finance. 48 lakh is the bank finance, right? So RBI say for 30 to 75 lakh loan, RBI says that for this range loan, right? What about the maximum LTV? Maximum LTV is also 80%, which is again 48 lakh. So now you see both the margin rule as well as the RBI LTV rule are both satisfied in the same value. That's why this is our correct option. Option number, let me show you. Yes, C is the correct answer, right? Because this both satisfy. Margin rule also satisfy, and you know, LTV rule also satisfy. This is the perfectly correct answer. What about option D? Option D says that the bank can lend 45 lakh because above 75 lakh loan can attract 75% margin LTV and banks should follow them stricter norm. Careful here. Our loan amount is 60 lakh. That fall in the range of 30 to 75 lakh. This slab it fall. Not above 75 lakh. Right. So 75% rule does not apply here. Hence option number D is wrong. So final answer is option number C. So what is the learning from this question? Must see. First of all, we learned is that margin is the borrower contribution. Remember it. Margin is the borrower contribution. Right. So here 20% is the margin, which means bank can give maximum 48 lakh. Now you must know the RBI LTV rule. What is the RBI LTV rule? It says that if loan amount is less than or equal to 30 lakh, right, in that case LTV will be 90%. If it lie between 30 to 75 lakh, then LTV maximum will be 80%. If it is above 75 lakh, then maximum LTV will be 75%. Just remember this LTV rule, super important. Maximum chance of repeating it in the upcoming examination. If you really think that this video is really helpful for your understanding, please hit that like button. So friends, remember, whenever you calculate housing loan limit, always check both margin requirement as well as RBI LTV cap. That way you will never get confused. Friends, if you are looking for study material for CCP, sure sort of study material which will helpful in the upcoming examination, you can clearly look out for our courses. In the description section of the video, you can check our CCP course. You can WhatsApp me on this particular number to get more detail regarding availing the course. 8292857381. Now friends, let's look at the question number 2. So now in this slide, we will talk about important MCQs on priority sector lending certificate. In short, we also call it, PSLC. Right. We call it PSLC. Priority lending lender certificate. Right. So the question is, which of the following statements are correct regarding the PSLC and bank loan to MFI? Option number A says that PSLC remain valid till 31st March and expire on April 1st. Option number B say that, bank can classify PSLC only if the underlying loan are eligible under the RBI priority sector norms. Option C say that bank can lend to registered NBFC MFI societies trust for on lending to individual SHG and JLG. Option number D say that PSLC may be issued for multiple quarter but expiry is still end of the financial year. Answer choices are A, B and C, B and D, A, B, C and D and A and C only. Very good question. Let's answer it. Let's look at option number A. Option number A is true. No matter when you buy the certificate, April, September, February, it will expire on 31st March. It will always expire on 31st March. No matter when you buy it. Right. Suppose a bank buy PSLC in January. They can use them only till March 31st. On April 1st, they are gone. Just like a movie ticket that expire after the show. What about option number B? Option number B, it says that bank classify PSLC under respective priority sector lending category. Right. Yes, this is also true. What we have seen, option number A is true. Question is asking which is not true. Not correct. Oh, okay, it's not correct. Option number B is also true. Because, PSLC are like, right to count. You can call them right to count. What does it mean, Basically, these are like, right to count another bank loan as your own priority loan. But if the underlying loan is not genuinely priority sector as per RBI, then buying a certificate will not help. Let me give you one example to make it more clear. Let's suppose that, if a PSLC is issued against a car loan, suppose again car loan, we have issued a PSLC certificate, right, for a luxury car. That won't qualify. Only loan eligible under PSL norms will count. This is called the count rule, right? Right to count. Now, option number C. Bank are permitted to lend to registered NBFC MFI society trust that are member of the RBI recognized SRO for on lending to individual and JLG SHG. This is true. This is correct. Why? Because RBI allow bank to support MFI. You know what is the meaning of MFI? Microfinance institution, right? Because lending to a small borrower, self-help group and joint liability, right? Because they lend to these kinds of category, right? So for example, suppose a bank give money to an MFI. Let me give you one example. This is the bank and what it give? It give money to MFI, right? And MFI uses it to give 20,000 loan to women SHG. right, in the village. So this indirectly fulfills the bank in the PSL target. Yes, that's why option number C is also correct. What about D? D says that PSL can be issued for multiple quarters, but their expiry will still be the end of the financial year. Again true. You may have PSLC transaction in quarter 1, quarter 2, quarter 3, quarter 4, but expiry does not depend on quarter. It is fixed on 31st March. Right. So friends, what we have seen that all options are correct. Right. So third number is the correct one. So what we have learned from this discussion is that, let me summarize. I told you, first point is regarding the PSLC validity. So remember, it is always ending on March 31st. Remember it. Second point I told you is regarding the, a classification. So, classification only if underlying loan are PSL eligible. Right. Then we talk about loan to MFI or on lending to MFI. So always on lending is allowed if NBFC, MFI, society, trust or RBI recognized through SRO. So if this NBFC, MFI, society, trust, they are RBI recognized through the SRO. SRO means self-regulatory organization. Then they are eligible. And multiple quarter. Yes, this is another point. This is called multiple quarter. Multiple quarter means possible, but expiry is fixed at the financial year. So friends, the key takeaway is that PSLC are valid only till the end of the financial year, and bank must always ensure that PSL eligibility of underlying loan. Also, lending to MFI is encouraged to meet the PSL target. I hope this answered your question. Now friends, let's look at one more important topic. Which of the following statement regarding the creditor turnover ratio is or are correct? Very good question. So friends, options are: a high ratio indicate that the company is prompt in paying supplier, reflecting a strong credit worthiness. Option B, a low ratio may indicate delayed payment, but can also occur if the company enjoyed longer credit period allowed by the supplier. For calculating the ratio, only credit purchase are considered as numerator. If credit purchase is missing, total net purchase can be used. Option D, average account payable is calculated as the average of opening and closing balance of the account payable. If opening balance is unavailable, then closing balance can be used. Very good question. Question is, which of the following is or are correct? Let's look at option number A. Option number A, yes, it is correct. Because this ratio tells us how many times in a year a company clear its dues to the supplier. That is what creditor turnover ratio means. What is the meaning of it? Let's try to understand. Suppose you have a company, you have a firm, and you have taken you have availed some goods, you have availed some kind of services on credit. You have not paid yet. So basically you have to clear your dues. So how many times a year you are able to clear your dues? That is what this creditor turnover ratio is all about. If the ratio is higher, it means company pay quickly and multiple times in a year. Right, simply you can think. So question may be asked in the form of numerical, but if you know the logic, you can easily answer it. Right. So if the creditor turnover ratio is higher, what does it mean? Company pays its dues very quickly, and since it pays its dues very quickly, multiple time in a year. So let me give you one example to learn it. Suppose there is a shop, and that pays its supplier every month. Right. So that is the 12 time in a year. Right, 12 time in a year. So it is a high ratio. So supplier trusts this shop. So yes, option number A is correct, reflecting the stronger credit worthiness. What about B? It says that a lower ratio may indicate delayed payment. Yes, this is also true. When the creditor turnover ratio is lower, it looks like a negative sign because it suggests slow payment. Yes, it's a negative sign because it suggests the slow payment. Right. But sometimes, it simply means supplier have given the company longer time to pay, say 90 days instead of 30 days. So a big retail chain might negotiate longer payment term with supplier. So ratio look low, but it's not a problem. It's not always a problem. It indicates delayed payment, but it can also occur if the company enjoy longer credit period. Yes, supplier has given longer credit period, then it can also occur. What about C? For calculating the ratio, only credit purchase are taken into numerator. See, this is also true. If you talk about the formula of the account turnover ratio, creditor turnover ratio or account payable turnover. So what is the formula? Very simple, right? You write the net credit purchase in the numerator, right? In the denominator, you write the average account payable, right? Now the question is, why only credit purchase? Because payable means money owed to the supplier, and the cash purchase don't create payable, right? That's why only credit purchase. But if the company does not give a credit breakup, then we have to use total purchase as a substitute. Now what about option D? Option number D says that average of the opening balance and yes, A, B, C, D all are correct. So what we learned regarding the credit turnover ratio or account, or you also call it account payable turnover. So remember, if this ratio is higher, so high ratio, what it means? Fast payment. High ratio means fast payment, which indicates good credit image. It gives you good credit image. And if the ratio is low, low ratio means delayed payment. Low ratio means delayed payment or long supplier credit, right? Then I told you the formula for account payable turnover. In the numerator, you write the credit purchase. In the numerator, you write the credit purchase. In the denominator, you write the average account payable, right? Average account payable. The credit purchase upon average account payable, that gives you account payable turnover or credit turnover ratio. And sometimes account payable, if you want to find it, so you write the opening balance plus closing balance divided by 2. Means at the beginning of the year, how much was your balance? At the end of the year, how much is the balance? Divided by 2. That will give you average account payable. Therefore, all the 4 statements are correct. So friends, remember, this ratio basically shows that how disciplined a company is in paying its supplier, right? How disciplined a company is paying supplier. High ratio means quick payment. Low ratio could mean delayed or simply longer credit term. I hope you like this explanation. Now friends, let's look at the next question. So question number 3 of today's session is on your screen. As you can see. Yes, the question is regarding the CRILC. Very important question. It asks you that which of the following statement about CRILC and SMA categorization is or are correct. Option number A, that bank must report to CRILC all credit information of borrower with aggregate fund limit and non-fund based exposure of 5 crore and above. Means reporting of borrower 5 crore and above. Option number B talk about crop loan exemption. So says that crop loan are exempted from CRILC reporting, but other agriculture loan must still be reported. Option C says that interbank loan are not reported, right? Like NABARD, SIDBI, Exim Bank, and HB, they are not required to be reported. And option number D says that SMA 0, right? SMA 0, 1, 2 classification. Right, SMA 0 refers to account not overdue beyond 30 days. SMA 1, 31 to 60 days. SMA 2, 60 to 90 days. And option number E says that failure to report SMA status or concealment of actual account stress may lead RBI to impose accelerated provisioning or other supervisory action. Very good question. Let's look at option by option. First of all, option number A. Right, let's have a look. So basically, this option number A is true. Why? Because, if we talk about the CRILC, it's like a database. It's like a database at RBI where banks share details of large borrower, right? If one borrower take loan from multiple banks, so CRILC, this act like a database. You can think of it like a database. Okay. And suppose this is a one borrower, right? Suppose this one borrower has taken loan from multiple banks. This is bank number 1, this is bank number 2, this is bank number 3. In that case, what will happen? This CRILC will help RBI, right? And bank see the total exposure. Bank always see the total exposure. Just remember it. Let me give you some example. Suppose a company has 6 crore loan, right? It is spread across 3 banks. Suppose 2 crore here, 1 crore here, and 3 crore here, right? So what the rule says that all bank must report it to CRILC. Every bank has to report to the CRILC, right? That's why option A is correct. What it says that bank must report to CRILC all credit information of borrower with aggregate fund base of 5 crore and above. Option number B says that crop loan are exempted from CRILC reporting. Yes, this is also correct. Why? Because crop loans are seasonal and short term. RBI keep them out to avoid unnecessary reporting load. So the reason behind it. The reason is very simple. The crop loan are seasonal. Crop loans are seasonal and also they are short term, right? So RBI keep them out to avoid unnecessary reporting load. But if it is another type of agriculture loan like tractor loan, warehouse loan, it must be reported. Suppose it is agriculture loan like tractor loan or warehouse loan, it must be reported. But crop loan need not to be reported under the CRILC, whatever be the amount. Now option C, that exposure like interbank loan, right, including to NABARD, SIDBI, EXIM, right, SIDBI, EXIM, bank, they are not reported to CRILC. That is option number C. This is also correct, right? Because these are called interbank loan. Interbank loan are more of institutional arrangement. Remember, these interbank loan, they are more of institutional arrangement. These interbank loan, they are more of institutional arrangement, right? Not customer level risk. They are not customer level risk. So if a bank A lend to NABARD, that does not go to CRILC. Very, very important part I'm telling you. That suppose there is a bank A, and this bank A, it lend to NABARD. Bank A lend to NABARD. It will not go to the CRILC. So C is correct. C is also correct. What about D? D says that SMA 0. So SMA categorization. Yes, this is exactly how it works. Let's have a look. So if you talk about the SMA categorization, as you can see it here. So SMA 0 means account not yet overdue but showing stress, like check bounce, stock statement delays, right? Then SMA 1 means overdue for 31 to 60 days. SMA 2 overdue for 61 to 90 days, right? For example, let's take one example. Suppose there is a borrower, right, who misses payment by 45 days. He misses payment by 45 days. So as per the rule, it will be covered under SMA 1, right? And if the delay is 75 days, which lie in 60 to 90 days, then it will be under SMA 2. So D is correct. If you look at the option number D, yes, it is correct. What about E? E says that failure to report SMA status or concealment of actual account stress may lead to RBI to impose accelerated provisioning. Yes, that is also true. You see the condition for imposing the accelerated provisioning. RBI is very strict. If a bank try to hide a stress account or to make it book look goods, RBI can force higher provisioning or other penalty. So we can see that all the options are correct. A, B, C, D and E, all are correct. So what we learned from this discussion is that, first of all, I told you about CRILC reporting. Exposure above 5 crore and above. Just remember this point. Exposure above 5 crore and above or 50 million and above. Right. Then I have to talk about crop loan. Crop loan are exempted, but other agri loan must be reported. Then I told you about, basically, I told you about interbank exposure. Remember it, interbank exposure? So they are not required. Interbank exposure, they are not required to be reporting to CRILC. And SMA 0, no overdue. But not overdue, means overdue less than 30 days. SMA 1, 31 to 60 days. SMA 2, overdue between 61 to 90 days. And I told you that, supervising action, that RBI can impose penalty and accelerated provisioning. So friends, remember, CRILC is RBI watchdog for big borrower. And SMA tagging is an early warning system for NPA. I hope you understood this background. Don't forget to hit the like button. This will motivate me to make more such content. Now friends, have a look at the next question that we have. So now we will discuss a very important MCQs on adjudicating authority under the Insolvency and Bankruptcy Code, commonly called IBC. We will check each option one by one, understand in simple word, and then pick the correct answer. So the question is, which of the following statement regarding the AA? You know what is AA? Adjudicating authority under the IBC are correct. Option number A, NCLT act like a AA for insolvency and bankruptcy procedure of the corporate and LLP. Option B, DRT act like a AA for insolvency, resolution and bankruptcy of individual. Option C, appeal against DRT order, that is the part 3 of the IBC. It goes to the DRT. Option D, appeal from NCLT order, go directly to the DRT. Very good question. These are the 4 options that we have. Let's look at option number A. So option number A, it is true. Yes, option number A is quite true. Why it is true? Let me give you the reason. Because NCLT, it handle insolvency for companies and LLP. Yes, right. Like suppose a big company like ABC Limited default, then insolvency case goes to the NCLT. So yes, it is the correct one. What about option B? If you look at the option B, this is also correct. Because DRT or Debt Recovery Tribunal, they look after small entities like individual or partnership. Right. So suppose if a small partnership or business or an individual default, then the case go to DRT, not NCLT. Option C, appeal against the order of DRT will be filed before the DRT. Yeah, this is also true. DRT stands for Debt Recovery Appellate Tribunal. It is the highest authority of DRT. So if someone is unhappy with DRT decision under IBC, they can appeal to DRT. What about option D? Option D is wrong, because here we are talking about the corporate case, right? Here we are talking about the corporate case. So just remember, if you talk about the corporate case, NCLT is the first stage. What is the first stage? First stage is the NCLT. First stage is the NCLT. Appeal goes to NCLT, not DRT. Appeal goes to the NCLT, that is the National Company Law Appellate Tribunal, not DRT. For example, if NCLT passes an order against a company, the appeal cannot go to DRT. It must go to NCLT. So option D is incorrect. Right. So what is the correct answer? A, B and C. Yes, this is the correct one. A, B and C is the correct one. So let's quickly summarize the key point which we have just covered here. So we started with NCLT. I told you that NCLT, the key takeaway is that, corporate goes to NCLT, individual goes to DRT, and also appeal from NCLT goes to NCLT, while the appeal from DRT goes to DRT. You can think of it like this. Suppose this is the corporate and this is the individual. So corporate goes to NCLT, individual goes to DRT, appeal goes to NCLT, and appeal from here goes to the DRT. Right? I hope you like this clear explanation. Now let's do one numerical based question based on it. Let's do one numerical based question. Now very good question it is, and this question was recently appeared in the examination. Let's have a look. So the question says that the borrower has an outstanding loan of 50 lakh, right, and a security worth 20 lakh. The loan is partially covered under CGTMSE for 75% of the unsecured portion. And they are also saying that account has slipped under the D1 category. What is the meaning of D1? D1 means doubtful one, right? Account has slipped under the D1 category or doubtful one category. So question is, as per the provisioning norm, how much provision should the bank create? So very good question it is. So options are 10 lakh, 12.5 lakh, 15 lakh and 20 lakh. So now let's see the step-by-step explanation here. Right. I request you to please pause the video first and first try it yourself. Very, very important thing I'm telling you. If you don't try, then you will not able to understand the pre-concept. If you do mistake, then you can easily remember it. Right. So outstanding loan 50 lakh, collateral is 20 lakh, CGTMSE covers 75%, D1 category. This data have been given. Now, first of all, let me show you the data. What they have given? They have given outstanding loan. How much? 50 lakh. Okay. So this is the total amount that borrower owes. Then we have the secured portion. How much is the secured portion? 20 lakh. Because collateral worth 20 lakh is available. Now, D1 category. So for D1 category, RBI says that for secured portion, provisioning to be done is 25% of the secured. That is what RBI say. That is the provisioning. 25% of secured. Now, can you tell me what is the unsecured portion? What is the unsecured portion? Very simple. 50 minus 20. Right. 50 minus 20. So how much? 75% of unsecured. 75% of unsecured means 75% of 30 lakh. What would that be? 75% of 30 lakh is how much? So it will be, I think 22.5 lakh. Right. So that means government guarantee cover 22.5 lakh. Now what is the bank net unsecured exposure? So net unsecured exposure is how much? Very simple. 30 minus 22.5, which is equal to 7.5 lakh. Right. So now the question is, how much is the provisioning? How much is the provisioning or unsecured? So unsecured we have 100% provisioning. 100% of 7.5 lakh. That would be 7.5 lakh. Right. So if you talk about the total provisioning, if you look at the total provisioning, it is how much? Secured is 5 lakh. Unsecured is 7.5 lakh. So total become 12.5 lakh. That is why 12.5 lakh is the correct answer. Yes, let's look at the correct answer here. The correct answer is 12.5 lakh. So we have to separately calculate, right, for secured and unsecured. So what we learned from this discussion is that, remember, for secured portion, right, for secured portion in D1, provisioning is 25%. For unsecured portion, provisioning is 100%. If a guarantee like CGTMSE is available, reduce the exposure accordingly. Right. And total provisioning is sum of all of them. So that is how because of this CGT-MSE coverage, right? Earlier one secured was 30 lakh. Now it reduced to just 7.5 lakh. That's why it is zero. So friends, the key takeaway is that always split the loan into secure and unsecured. Apply RBI provisioning percentage and don't forget to adjust for guarantee schemes like CGT-MSE. I hope this is a clear explanation to this particular question. Now, let's look at the next question. Question is asking you, which of the following statement about the leverage ratio is or are correct? Option number A, the commonly accepted leverage ratio is calculated as total outside liability by tangible net worth, where TNW is net worth minus intangible asset. Option B, it says that a conservative approach to leverage considered adjusted TNW, which exclude loan, advances, and investment in group associate subsidiary company. Option C, the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt divided by net worth in an existing company. And option D, in financial or media analysis, solvency is tested like or total outside liability divided by net worth expressed as a plain ratio. Now let's start with option number A. So if you talk about the option number A, it says that let me give you one example to give you a clear picture of it, how it works like, right? So here, let me give you one example. Let's suppose that a company has 100 crore liability, 100 crore liability of a company, and the net worth they have is 50 crore. Fine. But out of this 10 crore, right, out of this 10 crore is goodwill. And you know goodwill is a kind of intangible asset, right? So what is the tangible net worth? Tangible net worth is how much? Very simple, 50 minus 10, which is equal to 40 crore. That is our tangible net worth. Simple. Out of net worth, you subtract the intangible, you will get tangible. 40 crore is the tangible net worth. So leverage ratio is what you know. This 100 divided by 40, liability divided by 40, which is equal to 2.5 times. So it means that for every 1 rupees of the real money owner puts in, company has borrowed 2.5 from outside. So this denominator shows what? 40 crore. 40 crore means what? You know, 40 crore is your tangible net worth. Tangible net worth means for every 1 rupee of the real money puts in, company has borrowed 2.5 from outsider. That is the liability, right? That is what, you know, leverage ratio tells you. How much leverage you have taken, how much you have borrowed. Leverage means borrowing power. So in the numerator, we always write how much we have borrowed versus how much net worth. Now, what is option number B says? Option A we have just discussed. Option B says that a conservative approach to leverage considered adjusted TNW, which exclude loan, advances, investment in group, associate, subsidiary company. So why? This is correct. Why this is correct? Because if you have invested money in your own group company, that money is not freely available to pay the creditor. So bank cut it out. So let me illustrate it with using an example. Let's say that TNW is 40 crore. Tangible net worth is suppose 40 crore, right? But you have rupees 5 crore. So 5 crore invested in your sister company. So 5 crore has been invested in the sister company. So what would be the adjusted TNW? So adjusted tangible net worth would be how much? Very simple. 40 minus 5, which is equal to the 35 crore, right? So it gives a strict picture, right? It gives you a strict picture. Now what about option number C? Option number C says that, you know, it says that the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt versus net worth in an existing company. So you see, if you have a new project, try to understand. If you have a new project, that suppose project cost is 100 crore, right? So let's take one example to illustrate it. Suppose we have a new project and the cost of project is suppose 100 crore, and suppose the debt which we have taken is suppose 670 crore, and the promoter margin, or we call it equity, is 30 crore obviously. So what is the debt equity ratio? This is 70 upon 30, which is equal to 2.33. This is for new project. Suppose we have an existing company. If it is an existing company, suppose long-term loan is 60 crore, net worth is 40 crore. In this case, debt equity ratio is how much? It is nothing but 60 upon 40, which is equal to 1.5, right? So it has two meaning. That is the correct one, right? D can indicate the ratio between the debt and margin or long-term debt versus net worth. Yes, this is also correct. What about D? In financial or media analysis, solvency is tested like total outside liability divided by net worth. So you will often read the headline like company X has solvency ratio of 2.8. So what does it mean when I say company X has solvency ratio of 2.8? It means that for every 1 rupees of its money, company owes 2.8 to the outsider. So what we learned from this discussion is that, all the 4 options A, B and C, G and are correct. Yes, all the 4 options are correct. So correct answer is 4. So what we have learned, let me summarize. First we talked about the leverage ratio. Leverage ratio is simple. Total outside liability divided by tangible net worth. Tangible net worth is net worth minus intangible asset. Just understand leverage means how much you have borrowed fund as compared to how much fund the owner has put into the system. Conservative adjustment says that, basically to be stricter, bank and regulator subtract loan advance investment in the group associate subsidiary company from T&W. Then I told you about debt equity ratio. In project finance, debt equity means debt divided by margin, right? In the analysis of existing company, debt equity ratio means long-term debt divided by net worth. So friend, the takeaway is that solvency ratio basically measures how much outsider money a company is using compares to the owner money. So friends, that is all about this particular session. We have some more questions available. If you want me to clarify all those questions, discuss all those questions, please write yes word in the chat box. I will provide you the video, second part of the video. If you really think that this was helpful for your preparation,